Thank you, Harmony, and thanks everybody for joining us for the FY21 annual results for the Mader Group. We're really pleased to be able to communicate our results today, and I'd firstly just like to thank the Mader team for all their hard work, commitment, and dedication through what's been a reasonably challenging year. But to deliver results like this, we're really happy. So thank you, team, for in the field and in the office for helping this go ahead. I guess, look, to give a bit of background for those who aren't familiar, I'll spend a couple of minutes giving some background to the business before we move into our FY21 results. So, as you can see here, we're a specialist services company to the mining and civil industries. Starting off with one man in a vehicle doing field service out in the Kimberley, that soon became a bunch of like-minded friends. To a very strong culture-driven business that's grown to 1,600 employees today, with 700 field service vehicles supporting nearly 250 customers across nearly 400 mine sites across the world. So a huge amount of growth for this business. Also looking at the timeline there, you can see through the years, through several down cycles in the market, the group has continued to be able to use the disruptive business model it has to continue to grow through all cycles. The strong culture and belief in the business has really been key to this. Starting out with our founder Luke Mader, who had that vision, has really infected everybody in the business today, and really the core of the business hasn't changed, so that culture has remained incredibly strong. The belief that the business model has helped us grow and replicate the business model in a variety of different trades, geographies, and service industries. The commitment of the team has been critical to our growth and our ability to continue to attract and retain people in a very tight market. Also our ability to deliver a safe and high quality product through the investment in our people, in our culture, in technology, and care for our employees. Having a look on the slides here, we can see the demographic of our business consists predominantly of 25 to 35-year-old tradespeople, and we've been able to build a business that has given those people a huge variety of options and career paths that they can follow. Whether that be different rosters, whether it might be fly-in, fly-out, or vehicle-based roles, working across different states, across different countries, working on different machine types, and our Global Pathways initiative has allowed us to offer things such as working stints over in Africa, Papua New Guinea, and the United States, and soon to be Canada. So our ability to offer so much flexibility and so many career paths for our people, both trade-based and office-based, has been a huge attraction tool to the Mader Group, and so it's allowed us to continue to grow and to continue to develop our people and give options and opportunities as we grow this business. As you can see, we've got a huge range of products, and what predominantly started out as heavy-duty diesel mechanics has soon turned into auto electricians and boiler makers and fixed plant mechanical fitters, to name a few. We've been able to use that same business model to provide huge value for our customers, a variety of options and opportunities for our people, and by being with so many customers across so many mine sites, has given us opportunities to identify other areas of growth where we could use our business model to add value. And you can see on the slides there our core mechanical services on the top there, which has also identified the need and the requirement for other stores that have helped us to implement a growth strategy, which again, we're putting motivated, dedicated experts in their field into running these stores and growing them and delivering value across the industry. the business model we have, again, it's been rolled out 20 times with 100% success rate. So we've got absolute faith in the model. We've got faith in the teams that are out there delivering this stuff, and we're able to continue to go forward, replicate that business model, apply that to other areas of opportunity, and to grow our business into the successful business it is today. When we look at our method of engagement on the right-hand side of that slide, it shows the contracted versus uncontracted revenue profile of our business, and that's really important. Our contracted part of the business, again, would typically involve a master framework agreement with a large owner miner, which we have an opportunity to have an annual rise and fall mechanism with zero guarantee volumes to protect any pricing downside. So if the market outruns the rates, our ability to get back in front of our customer and ensure that we're in line with market movements, is there for us to have. The uncontracted part is typically our more reactive sort of workforces, very much recurring scopes of work, but gives us flexibility in pricing, and also gives our customers the ability to have reactive services to meet their needs, which is certainly a very popular one for us. So moving into to an operational review. So again, very pleased to be able to deliver these numbers to everybody today. The highlights for FY21, that's $304 million revenue. So breaking through that $300 million revenue barrier has been a great achievement. Up 11% from FY20. Increase in EBITDA, $19.3 million NPAT, which is up nearly 11% from FY20. Remaining very capital light. Net debt of $23.9 million. Continuing to pay around a third of our profit in dividends, so $6 million declared for FY21, which we think is a fantastic result for our shareholders, with a 9.67 earnings per share. Our recruitment focus continues to be huge, and again, we've got a fantastic team of recruitment experts that can go out and find and source and engage the best people in the business. We're giving the right people the right opportunities, and as I said before, having so many options for people to be able to choose from within the Mader Group makes us a very attractive employment prospect for the tradespeople we're chasing. We can put the right people in the right opportunities and ensure their career is going in the direction they want. Our investment in fleet, both in Australia and overseas, has been significant. That said, it has been all growth capital. So when we see our capital intensity rise, it's always to grow. This isn't sustaining capital. This is all growth capital. So as we're penetrating markets in North America and Canada and across Australia, we do so with our reactive vehicle-based services typically, and then field labor behind that. So seeing that investment again is a great sign of growth for the Mader Group. And returning into work in Asia and Africa. So very much controlled by the COVID situation, but we're being very selective as to where we go and who we work with. But the demand for our services is extremely strong, and we're just negotiating through those travel and COVID sort of restrictions as we return to work in those parts of the world, making sure firstly and foremost our people are safe, and that we can move them in and out as they require. So to see that rest of the world business turn on has been really pleasing. I think as an overview of our operations, you can see there the revenue split. Certainly Australia owns the lion's share of that. USA growth has been fantastic from FY20 to FY21, and continuing to see a variety of green shoots there. And the rest of the world, again, that was backed off to zero as a result of COVID, for us to be able to switch that back on and ramp that up is a great pat on the back for the international team. Certainly our product splits as well. So, as we said, working with 250 odd customers across 350 plus mine sites. Our diversity in product split has been good and continues to grow. Iron ore being a large Western Australian-based company we're in, is obviously the lion's share of that. But the diversity across some of the other commodities, again, is very reassuring and very positive for the group. I was going to say, that said, the demand for our products across all of those commodities and in all of those geographical regions continues to be very strong, and we see that opportunity for growth continuing to grow. So moving into some of the other highlights there. So Australia, increase by 11% in our revenue number there. Some areas of highlight there around our ancillary services and our infrastructure services at 21 and 24% respectively has been extremely positive. We continue to bolster up the management teams and the coordination teams in both of those areas as we see those becoming huge stores as we move forward. The fact that we've got nearly 100 apprentices in the system, we're training up new talent. Again, most of these are very dedicated and loyal people that will continue with the Mader Group for years to come, which is fantastic to see. I'll move across to the other side, the rest of the world. Again, that number doesn't look great as far as being down by 47% revenue, but to note that was intentionally wound off. A couple of years ago, that was around a $28 million revenue business. That went down to zero in July as a result of ensuring the safety of our people was priority. We moved those people back and redeployed them within Australia, and now they're starting to come back into the rest of the world part of the business. That half one to half two revenue is probably what's more important there, around that 117% growth, and continuing to work with some of the constraints around COVID to gradually deploy people back into areas where it's safe to do so. And I suppose the one that we're most excited about is our North American contingent. So 75% increase in revenue growth. Despite some quiet months, through the thick of COVID over there. Great to see the team being able to negotiate that and really more of a business as usual state there. So seeing those growth numbers back to pre-COVID levels and probably more with some huge growth ahead of us. Working in 14 states across the USA, which is fantastic. The investment in the service vehicles again helps us to really penetrate the market over there, both in the USA and Canada. And I guess all the back end work for Canada has been done now, and work in Canada is imminent. So we've got people pegged to go in there and commence work in the next few weeks, which is very exciting for us. So I'd like to hand over now to Paul to take us through the financials, please.
Thanks, Justin, and thanks everyone for joining us this morning. I'll move on to slide 10, financial performance, and just some highlights around the profit and loss. As Justin mentioned, group revenue growth 11% PCP, and strong revenue growth in North America at 75%. Probably more pleasing on the North American front, excluding foreign exchange movements or on a constant currency basis, that business unit or segment grew by 95% PCP, which is incredibly pleasing. North America revenue contribution consisted of 8% of group revenue. That's up from 5% in the previous financial period, which is pleasing. That the size of the pie is growing, and the size of the US contribution is also growing with it. Strong revenue growth in the rest of the world, half to half, up 117%, which, as Justin alluded to, really demonstrates that as we return that business to normal, there's some strong growth potential there. EPS was up 11% and our profit payout ratio was around 31%. So ensuring consistent returns to shareholders there. Moving on to the financial position, which is a pretty simple slide to run through. It is a very simple balance sheet comprised primarily of trade receivables and PPE. The net debt position stands at $23.9 million with overall net leverage at 0.7 times. We talk about the level of comfort in that net debt position, and we always peg that back to an internal metric of 50% of trade receivables. If you do the maths on that, we believe we have comfortable headroom in that net debt position as we grow into FY22. We deployed $11.2 million of growth capital in FY21. That's 100% of CapEx was all growth capital, and we're well positioned for growth in FY22 with plenty of headroom in our unutilised debt facilities and well supported by our banks. Moving on to the cash flow on slide 12, delivered net cash flow from operations of $16.2 million, which was solid. Strong cash conversion at 84%, and as I alluded to on the previous slide, strong investment in growth, predominantly in the US and North American markets, and that was, as I said, 100% growth CapEx. It's probably enough for me before everyone falls asleep on the financials. Justin, I'll hand back to you now.
Where do we go, Eggsy? Okay, so moving on to the outlook. When we look at our geographical footprint as we stand today, our major revenue base is still in Australia, and to see that growth throughout the whole country has been fantastic to see across a variety of different commodities. The US growth is definitely back to some strong numbers and some big prospects ahead of us in the USA and moving into Canada. And the rest of the world definitely back online, and that's growing significantly quarter by quarter. So to deliver the numbers that we have with that geographical footprint, without a rest of the world business, to see that growth has been a real credit to the Mader team. So I'd like to thank them again. If we look moving forward, I mean, this is the one that excites me the most. When we look at Mader, it has really started to become a global business, and the hard work from the team across the globe has been nothing short of extraordinary, but really puts us in a strong position to grow going forward. If we look at the ROM tons there, particularly in the North Americas, the opportunity to really disrupt and penetrate those markets and grow significant businesses, potentially in excess of what we got here in Australia, is very much there in front of us. The rest of the world, again, we're negotiating through some of the travel restrictions and work permit restrictions as we have in those parts of the world, as everyone is in this COVID situation. But as we see that ease up and that ability to travel become a lot freer, the demand for the products over in those parts of the world is extremely strong, and we're looking forward to servicing our customers over there. If we have a look at the group outlook and guidance, look, in summary, we think the business is very adapted to the COVID situation. Pleasingly now, we've been in a position where even with the current lockdowns we've got across the country, people can isolate and still travel to Western Australia, our eastern states-based employees. Those that don't want to, we have enough work at both ends of the country so that people are able to work in their home state while lockdowns are happening before they return to a normal roster on the other side, which is something that a lot of companies cannot offer, and again makes us a very, very strong employment opportunity for those people. The diversification strategies, both geographical and service strategies, continue to be really, really strong. So we're bolstering up our teams both in the field and in the office, with subject matter experts in their areas of expertise, to continue to grow, use the Mader business model to grow that business. And we're also looking at some different acquisition potentials being explored as we speak. So more to come on that in the months to come. Looking into Australia, the strong commodity markets, obviously, as everyone's well aware, we're well poised to take advantage of that. Our expert team of recruitment and coordination and management personnel are laser focused on people, making sure that the culture is strong. We get the right people, they work safely for our customers, and we earn the right to grow this business. We've got a very loyal customer base who we continue to support. There's still a bunch of mega projects coming online, which again, with new equipment coming online, creating that maintenance requirement, puts Mader in a great position to service those opportunities. The equipment population is expanding, so again, there's a myriad of new equipment going into the industry. That said, very, very little coming out, so that is all growth potential for us with an aging population of many machines that are out in the industry at the moment, creating that maintenance debt that we can again go and assist our customers in servicing. And our service offering diversification, so we talked about our ancillary teams, our infrastructure maintenance teams, amongst a bunch of others, both geographically and service spread as well to continue that growth. North America, again, we're seeing a huge growth potential in that part of the world. We've invested heavily in vehicles to continue penetrating that market. Our recruitment efforts over there are going very well, so we're continuing to grow at a great rate over there in the US. There's giant addressable markets in North America, and that Canadian entry is something we're pretty excited about too, which is really quite imminent. The rest of the world, again, it is opening up. We're baby steps in that space, but we're moving in there as we can. Very selective and targeted re-entry around who we're working for and where we're working. That said, there's some really good green shoots in that space, and we expect to see that grow this year. As conditions stabilise, we'll just continue with that selective re-entry into those areas. And I suppose what most people on this call are looking for is our FY22 guidance. So we're pretty pleased to be able to present that. So a revenue forecast in the range of 355 to 365 million, which is up from our 304 in FY21, with an NPAT forecast somewhere between 23 and 25 million, up from 19.3 in FY21. So the team is very focused, very dedicated, and looking forward to delivering those results. So we'll look forward to getting on with that. If I look at that, that investment case, I think we've sort of been through that, but I mean, it's a proven business model. It's something that we've got a very dedicated and highly functional management team that can get in behind that, can scale it, grow it with some expert trades in their fields of expertise. The domestic and international growth opportunities are in front of us. So we need to just continue to remain disciplined and to get the right people in the business to deliver safely for our customers, and we'll continue to earn the right to grow this business. Our low capital intensity, as Paul talked about, is a significant advantage. We invest in growth capital only, essentially, and that is around our service vehicles. The teams are in a great position to continue that growth and continue to push forward and deliver some great numbers into FY22 and onwards. So we look forward to continuing to talk through that as we move forward. So everyone, that's our presentation for today. So thank you very much for joining us. We're really pleased with our results, given a fairly trying year through the COVID situation. But again, I just want to thank the Mader team, a great group of dedicated personnel across the board who are out there delivering this for us each day. So thank you, team, and thanks for everyone on the call for joining us. We might just move to a few questions.
Sure. Thanks, Justin. I'll just moderate these as they come through. A question for you, Justin, from Hamish Murray. Good morning, Hamish, from Bell Potter. US EBITDA and EBIT margins look very strong. We know that is to be the case. How do you expect these to evolve as you enter Canada, and can US margins be maintained in the near term?
Yeah, thanks, Hamish. Good question as always. Look, the US margins, we're not seeing any reason as to why they should change. We're continuing to grow into more states, working for more customers in more regions, and the rates that we offer over there seem to be very very fair and very well accepted by our customer base. So we expect to maintain those US margins. Moving into Canada, we see those being somewhere between probably the Australian and the US margins. So probably not quite as strong as the US, but certainly a stronger margin than we see in Canada. We've got a few different regions of Canada that we're exploring at the moment, and as we move into those, we'll be able to give some more feedback as that plays out. But we expect it to be somewhere in the middle.
Thanks, Justin. Another question coming through here. You talked about the service vehicle fleet. This is a question from Jason Palmer from Taylor Collison. Morning, Jason. Is it correct to say that the service vehicle fleet has a greater useful life than the depreciable life, and that therefore the return on invested capital should continue to improve as the business expands? Do you want to talk about useful lives of those assets and how we see that moving forward?
Yeah, sure. Thanks for that question, Jason. Look, absolutely. I mean, we've got, there's actually very few of our vehicles that have ever been moved out of the fleet. So some of the original vehicles are still out there earning money for us, essentially. So the depreciable life is a lot shorter than the whole useful life of that vehicle. So there would be a significant portion of our fleet that is fully depreciated but still in operation, and we continue to see that. We're not. I think, as I said before in the presentation, all this capital being spent on new vehicles is all growth capital. We're not tipping any out. This isn't sustaining capital.
Thanks. Another question from Hamish. How do we think about rest of world for FY22? Is that upside potential, or is that business as usual? How do we think about that?
Oh, it's a good question, Hamish, and you might be as well poised to answer that as I am. Look, hard to say. I mean, look, the demand for the services is definitely strong. We're seeing as the guys are getting vaccinated, we're seeing a lot more free movement into places like PNG, which is positive. So definitely expecting that to grow. It has been probably a little bit challenging with the COVID situation in PNG and the ability to move people back to Australia. That seems to be getting better now. What that looks like in 3 months from now, I wish I had a crystal ball on it. But look, the demand's certainly there. We have workforce that are really keen to go and work over there. So everything's sort of lined up. So if that travel situation frees up, then we're poised to deliver. Likewise in Africa as well.
Thanks. Another question from Jason from Taylor Collison. What are the labour turnover rates of the business, and how do you think about that in relation to the 98 apprentices and trade-up candidates? Is that just covering the LTO, or is that a core part of the business strategy?
Look, the apprentices are certainly a core part of our business strategy. Most of those apprentices we intend to keep within the Mader business. We invest significantly in them to go through the TAFE and upskill, and also buddy them up with our experienced tradespeople to give them the right grounding and the right experience in that heavy vehicle industry. So no, look, we see that as definitely an upskilling opportunity for these people, but also a definite growth opportunity for our business as well. So we intend to, as much as we can, keep those apprentices and trade ups within our business, and give them long careers in the Mader Group.
Thanks. A question for me from Hamish is just talking about FY21 EBITDA margins in Australia and the outlook for FY22. It looks like Australian margin pressures have been offset by other income, which is the apprenticeship booster from ScoMo. It's nice to see some money coming back the other way. Is this related to borders and quarantine? Hamish, broadly, yes. Whilst there is some cost impacts of those border closures, I must say that our workforce mobilisation teams have become very adept at moving people east to west and housing labour in the jurisdiction in which it needs to operate. And I do believe that those margins will normalise back to towards 11% as the world returns to normal. Moving through the next question from Jason, again at Taylor Collison. Talk us through we talked about rest of world revenue assumptions just then, or a little bit earlier, Justin. Talk us through what are you thinking for the US and Australia?
Look, the Australian market, I guess, look, the demand on our product continues to be strong, Jason. We're certainly recruiting as hard as we can. Essentially making sure that we've got the right people in the right places to continue to grow. So part of that, any restriction on growth is really sort of self-implied. I think the split, I think we should continue to see Australia grow in line with what we've seen in previous years. So the demand is certainly there. As those product, the diversity splits as things like our ancillary groups and our infrastructure maintenance groups, certainly supply some upside to some of those growth rates as well. So we're looking forward to seeing those grow and hopefully there's an even better number than what we've seen previously.
Thanks, Justin. Question from Marcus Burns from Australia. What are the limiting factors to growing faster in the US? Is there a current pricing limit there?
Thanks, Marcus. No, look, the US, I guess the limits to growth are probably in business development at the moment. That said, we're starting to see those growth rates really start to ramp up as we're doing more work in more states with more customers. But look, certainly where Australia is certainly more of a recruitment constrained environment. We see the US as again is developing the business name, is getting our product out there and growing that name in the US. So it's definitely a BD effort over there.
Thanks. Another question from Jason. Will group effective tax rates continue to be around the 28%, or will they scale backwards? I might jump on that question. Look, the US effective tax rates are lower than Australia, and as that business scales, the overall effective tax rate will come back. That's for sure, and it will be just a factor of time as to how quickly that occurs. A question from Roger Flynn: how many vehicles are leased? All our vehicles are purchased under asset finance, so they are our vehicles, and we pay them off over 3 to 4 years with effective lives much longer than that. CapEx assumptions. A question from Hamish: how do we think about CapEx for FY22? Yes, Hamish, it's a good question. We do see, we have made a significant commitment to CapEx in the US for FY22 as we see that structural growth improve. Our guidance for CapEx in FY22 is 100% growth CapEx, so no sustaining CapEx again, but in the range of 15 to 17.5 mil for growth CapEx. I'm just looking through see if there's any other questions that we haven't touched on. A question from Roger Flynn: Justin, how many of the 1,600 employees have hands-on tools? How many of them are tradespeople versus office staff?
They're probably across the globe, Roger. There might be 100, maybe just over 100 office staff. So the rest are trades based.
Yep. A question from PN Investments coming through: with the expansion in North America, would Mader be able to fund this expansion without having to raise more capital? I probably will jump on that one if that's okay, Justin. The way that we kind of think about our net debt profile is that we like to be at around 50% of our trade receivables balance. That's just an internal metric that we guide ourselves to. We have a significant growth CapEx agenda for FY22. As I just mentioned, around $15 to $17.5 million. We see that within our net debt numbers, we've got the capacity for a further $10 million of net debt before we start to review that, and we believe, therefore, that we can fund that US expansion in North America without new capital. I think that's another question from Marcus. If you talk about this one around pricing levels in Canada, how do you see them, Justin? Are they similar to Australia or more in line with the US pricing?
Yeah, I think it's probably similar to Hamish's question there, but yeah, look, we think somewhere in the middle between Australia and US prices and margins as well. So better than Australia, but maybe not quite as good as the US. But very early days, and we'll continue to test that market and see how that plays out. But certainly expecting some very good margins in Canada.
Thanks. Question from Nick on our trade receivables balance. What's the reason for the payment terms being between 30 and 90 days and not typically 30? Some colour around that, so I'll move into that. I think the majority of our customers are sort of averaging 45 to 60 days. That's the large owner miners, and based on the size of our service into those owner miners, you go into a tiered structure on payment terms, which means that you end up in that 45 to 60 day terms. We do have some clients pushing out to 90 days, but I think upon reflection, if you look at the quality of the counterparty on those trade receivables balance, they're tier one owner miners or blue chip mining contractors, and bad debts are not something that we entertain in this business. We'd always like the payment terms to be shorter, but that's the reality of working with these bigger businesses. Another question from Jason. Justin, I'll pose this one to you. Talking about organic growth in the US and potential M&A, talking about the strong growth in the core business, which has been phenomenal. How do you see M&A activity in the US in context to our organic growth areas in the core market?
Yeah, good question. Look, we're certainly not intending to acquire anything that sort of lines up with our core business. We're happy with our model and our ability to grow that. That said, I think if we look at similar sort of industries, I suppose, that support our business model, we are definitely looking at similar sort of businesses within the US. So our director of growth and emerging business, Pat Conway, is actually on a plane as we speak over to the US to go and look at a few opportunities over there. So I think if you ask me in a month's time, I should be able to give you a better answer on what we find. But look, certainly some positive outlooks there, and we'll go and do the due diligence on those and review accordingly.
Thanks, Justin. We've got time for probably one or two more. So another question from Marcus around Luke Mader, our founder and major shareholder. Do you want to talk about his involvement in the business on the day-to-day and that going forward, Justin?
Yeah, look, absolutely. Yeah, look, Luke's certainly very much in touch with the business. It's a good thing he's a good guy because I'm on the phone with him every day. But look, certainly very much in tune with what we're doing and giving guidance as and where he sees fit. But very much finger on the pulse.
Okay. There's a few other questions that have come through, Justin, but we're probably going to have to wrap it up for time, given the nature of the schedule for today. For those that we haven't responded to today, we'll reach out during the course of today to wrap up any other questions that you may have. But for now, I think we'll close it there. And thanks very much for joining us this morning.
Yeah, thanks everyone. Look, really pleased to be able to present those results, and look forward to working with you all in the future. Thank you.